Hey all, welcome to Retirement Journey with Raj. I'm your host Raj, and today I want to talk about the concept of exit taxes. Even before you decide on your destination, you need to find out about what it would cost you to leave your country. And this video talks about exit tax. And I provide a high level guideline for US, UK, Australia, and Canada. I also provide you with ideas on how to find the exit tax in the country of your residence, your tax residence. This is an information packed video. Let's get started. Welcome back, friends. The United States has an exit tax, also known as expatriation tax, that applies to certain individuals who relinquish their US citizenship or residency. It's important to understand that this tax does not apply to everyone who leaves the country. Here's a breakdown of the key points. The exit tax applies to covered expatriates, which includes US citizens who renounce their citizenship, and long term residents or green card holders for at least 8 out of the past 15 years. And the US exit tax uses a concept called deemed sale. It's as if you sold all your worldwide assets, excluding some exceptions, on the day before you expatriate, and you are taxed on the capital gains from the notional sale. There is a significant exemption for covered expatriate. As of 2023, the first 767,000 of capital gains from the deemed sale are exempt from any exit tax. Any gains exceeding this threshold are taxed at capital gains rates. Unfortunately, the US exit tax does not offer any deferral options. The tax is due when you expatriate. Unlike the US, Canada applies an exit tax on capital gains from certain assets, not on your worldwide income. So, luckily for me, I fall in this category because I live in Canada. And when you become a non resident of Canada, here's a breakdown of how the exit tax works. The exit tax applies to Canadian residents who are severing residential ties with Canada. So, you fill up a form which determines whether you are going to be a non resident of Canada. It's generally referred to here as NR. This is generally determined by factors like residency time, intention to return, and maintaining significant economic ties in Canada. So, components of significant economic ties in Canada could be a Canadian driver's license, residential property in Canada, or company in Canada, their membership of a society in Canada, things like that. So even if a spouse or a part of your family lives in Canada and you have left Canada, that shows significant ties to Canada. Now, Canada applies a deemed disposition rule. This means you are considered to have sold certain assets like stocks, bonds, real estate, excluding your principal residence, at fair market value on the day you become a non resident. You will be taxed on any capital gains accrued while you were a resident. Only half of the net capital gain from the deemed disposition is included in your income and taxed at income tax rates which are applicable to your income slab. However, of late there has been a change in the capital gains tax in Canada. The first, I think 250,000 of the capital gains has got 50% inclusion, and beyond that there is a 65% inclusion. That's my understanding. I'm still reading up to find what it is. So those of you who are Canadians who are planning to move out of Canada and become non-resident of Canada, either you're going to US or you're going to India or some other country, put some details in the comment section below, and I'll try to address some of your questions in my next video if I have the answers for that, because I have done a lot of search for my own self, and I would be happy to share some sources with you. But remember, I'm not a chartered accountant, so what I'm finding out is just as a layperson. So you'll have to consult a professional chartered accountant. But the objective of this video is to give you an idea of all the things that you need to consider before you leave Canada. And retiring outside of Canada essentially involves understanding what are the exit taxes. And if you're not happy with paying the exit taxes, you can always do snowbirding if you're a Canadian. That way you don't have the exit tax implication at all. And snowbirding is a well-established tradition in Canada, and you will not have any problems or surprises with it. So that said, Canada allows you to defer paying the exit tax until you actually sell the asset or return to Canada, whichever comes first. This can be helpful if you don't have the cash readily available. And to defer taxes, you need to file a form called Form T1244, which is election under subsection 220(4.5) of the Income Tax Act, to defer the payment of tax on income relating to the deemed disposition of property. And now for Indians living in UK, what I have found is that there is good news here. The good news is that UK does not have a general exit tax for individuals leaving the country. This means you won't be taxed on your worldwide income simply for emigrating. However, there are a couple of things to keep in mind regarding the UK taxes and leaving the country. So one of the things is that tax for the remaining tax year will still have to be paid. You'll still be liable to pay UK income tax and capital gains tax for the remaining tax year in which you leave. And this second part applies to you if you return to the UK within 5 years of leaving and were a resident for at least 4 out of the 7 tax years before you left. In this scenario, you might be liable for capital gains tax on asset disposals made during your non-resident period as well. So here is a breakdown. This does not technically function as an exit tax, but it applies to individuals in UK who become non-resident for a short period of time and then return back to the UK. The re-entry charge applies to capital gains on asset disposed of while you were a non-resident under the temporary non-residence rules. The tax rate for capital gains tax is variable depending on your income tax band. There are no deferral options for the re-entry charge, to the best of my knowledge. So this is at a very high level what I have gathered. And again, let me emphasize, I'm not a chartered accountant. This is not tax advice. But this generally gives you an idea of where to look for so that you avoid surprises when you decide to move out of your country of tax residence. Now let us look at what is the situation for Indians living in Australia. Australia does have an exit tax system, but it doesn't exactly function like a traditional exit tax that captures your worldwide income. Instead, it captures a capital gains tax on certain assets you own when you cease to be an Australian resident for tax purposes. And here's a breakdown of the key points. The exit tax applies to individuals who are no longer considered Australian tax residents. This is determined by factors like residency time, intention to return, and maintaining significant economic ties to Australia. To me, it sounds more like what we have in Canada. Australia applies a deemed disposal rule for capital gains tax purposes. This means you're treated as having sold certain capital gains tax assets like stocks, bonds, real estate, excluding your main residence, which we call principal residence in Canada. And the value is considered to be fair market value on the day you become a non-resident, and you'll be taxed on any capital gains accrued while you were a resident, and the capital gains are taxed at regular capital gains tax rates, which can vary depending on your individual circumstances. There are also capital gains tax discount and exemptions that might apply. So speak to your chartered accountant and find out what are the implications for you in terms of exit tax when you decide to leave Australia and go back to India or move to UK or Bali or some other destination like that for your retirement. So Australia offers two options for settling the capital gains tax. You can either settle the liability upfront when you cease residency, or you can defer paying the exit tax until you actually sell the asset. However, there are some drawbacks to deferral because you will be taxed at non-resident capital gains tax rates, which can be less favorable than residential rates, and you won't have access to certain capital gains tax concessions available to residents. So once again, I'm not a chartered accountant, and the information I'm providing is not meant as a tax advice, but just to highlight that anyone can find the basic information about exit tax in their country of tax residence by following a method of inquiry. Here is a general overview of exit taxes that you can incorporate in your understanding. 4 key questions have to be asked when you want to determine exit taxes. First question, who is affected? Exit taxes generally apply to residents who are severing ties with the country. This definition can vary depending on the country's specific rules. Check your tax code. Number 2, what is taxed? Exit taxes often target capital gains on specific assets like stocks, bonds, or real estate, unless it's your principal residence. The idea is to capture any appreciation in value that happened while you were a resident and to tax it. Third question is, how much is tax? The tax rate for exit taxes can vary significantly. Some countries have a flat tax while others have tax on capital gains at progressive income tax rate, yet others have an additional flat tax on top of it or just a flat tax. So you have to check this out. The fourth question is deferral options. Some country allow you to defer paying the exit tax until you actually sell the asset. This can be helpful if you don't have cash readily available. Other countries do not. So here are some tips for finding information on exit taxes. The best way to find out about exit taxes for your specific situation is to consult the tax authority of the country you are leaving. Their website should have information for immigrants, or you can contact them directly. And I would say that in these modern days, you have a lot of things you can do even before you start paying highly paid tax professional. First of all, you can go to the tax page of your country, copy the requisite tax section, and put it into ChatGPT and ask ChatGPT to explain it to you as a layperson. That will give you a very good idea. Number two, search for your country's name plus departure tax and plus immigrants. And you will be able to get links to trusted government websites where the information will be available. Again, if you are not able to make sense of what it says there, copy it, put it into ChatGPT and ask it to explain it to you and see if it makes sense. Once you have all that information, you can study and you can really make it worthwhile when you consult a tax professional, because the tax professional will charge you by the hour. And when you go to the tax professional, if you're already prepared with the background, the first thing is that you are going to understand the scope of questions that you want to ask the tax professional in your first meeting. And secondly, when the tax professional answers you, you have a comprehension of what they are saying so that you can put down additional questions in your notepad, come back home and prepare for that, and then go for the next meeting with the tax professional. This way, it is easier for the tax professional to help you, and it gives you value for money because you're more efficient in using the tax consultant, and the tax consultant will enjoy dealing with you and you'll really get a really good service. That's my personal opinion. So consult a tax professional specializing in international tax matters. They can advise you on the specific rules and help you navigate the process. I am continuing to drill deeper into the exit tax question to look at all possible scenarios. Investment properties and companies that you own can cause difficulty with exiting a country. Planning in advance can help reconfigure your assets to make the exit smoother and less expensive. Friends, I hope you found some value in this video. In the comment section, please let me know which country you live in so that I can understand the viewership and reflect it in the content of my videos and have more references to what happens in your area of domicile. So that's all for now, and I will catch up with you again in the next video. Stay tuned. Please hit the subscribe button and the like button and stay connected to the channel. Until next time, see you later. Bye for now.